Okay, hello everybody. Today, Monday, November 20th. I'm back with my buddy Imran on this Thanksgiving week, well, at least here in the U.S., Thanksgiving, for our Monday morning meeting. Imran, how you doing?
I'm good, man. How are you?
I'm doing great. We were talking about last week how a couple of our ideas went just bananas, namely IWM, which you can see up on your screen here. Let me bring that up. This had an incredible move. It showed up on our short volatility scanner. And as you can see here over the last couple of days, it really exploded higher. I'm doing not a great job of showing my charts, but as you can see here, it just really ripped. And so that one went really nuts. And then the other one that just had an incredible week because of earnings, really blowout earnings move. You can see here, Target showed up on our short volatility scanner as well. And so this was up some 20 odd percent. And so, in this case, we had recommended put spreads, selling put spreads, which pay out decently. But as you had noted, the IWM trade was selling put spreads to buy calls, and that worked out really very well. One thing on this before we get into your ideas, I would note that in terms of what I see for this week, I don't see a whole lot of interesting stuff on the volatility scanner, but IWMs did show up again, which suggests that there is still a little bit of VRP or volatility risk premium embedded in this index. As it is a shortened holiday week, I think I don't see anything that's super attractive here. We got NVIDIA earnings coming up, so I definitely want to steer clear of that name just as a general volatility risk premium scanning exercise. If you have some earnings trades, it's a separate thing, but outside of that, I don't really see anything too terribly interesting. But Target comes up for me as a squeeze name, which obviously is already up 20%. So I was a little surprised by that. But what's critical here is that the call wall shifted from 130 area up to 140. So we have a lot of gamma at 130. Bring back Target chart here. A lot of gamma here, which I think this is kind of the base area, 127 to 130. And I still think we have some decent room now to run up to 140. So that is the name that shows up in our squeeze scanner, which means that if the market continues to rally, as we think happens out of this week and kind of end of the year, Target could have some outsized upside in that case. However, we've been forecasting in our general notes for a window of weakness, and I'm using this as my transition mechanism into Imran's very interesting ideas here, which is buying puts on both JP Morgan and Intel. So Imran, now that I'm done with my long-winded diatribe to start the show here, talk to us about the trades that you have set up here. And
so one thing I want to make clear first about this strategy compass, right, is it is a mean reversion model. So the idea is not to say that anytime I put a trade idea out on this, it's going to work. It's just to say that I'm monitoring the top 30 stocks in that trade volume-wise in the US, single stocks, and I'm trying to get a feel for where they are in their ranges. And the way we look at their ranges is through Bollinger Bands, and then where their volatility is based on their percentile rank. So the range of that historic implied volatility. So then if you find that a name is pushing to one corner of the compass, that gives you that's saying that out of all the other names that I'm screening for, these ones look the most stretched. Right? That doesn't mean they're definitely going to mean revert. And last week, markets ripped, so nothing mean reverted, but they've been rallying for 3 weeks straight now. So if you've been of the mind that the rally is going to keep going, then you don't want to be executing any of these ideas because it goes against the trend in the market. If you think the market's going to reverse lower, then we're showing you that these names are the ones that look the most stretched to me in the near term, given that their volatility might be on the low end of things, their spot might be on the high end of things. So if we do get a snapback, these have got lots of room to snap back. That's the value of the model, and that's why we're putting it out there daily for our subscribers. I just want people to understand that. So I think some people have been getting confused about that.
Well, I'd also add in here is that this highlights kind of a very interesting point, and it's an argument that I have with a lot of our members, in that this idea of negatively versus positively skewed payouts, in that a lot of people like to sell call spreads because they're like, look, I'm right 8 out of 10 times. You make 10 cents or 20 cents on your call spread when you sell it, and you're correct. But then you have that one that goes against you and you lose $5, right? And that's the that's where payouts obviously can be skewed. Whereas in this case, odds are kind of almost the other way where, look, we're going to buy these puts or calls based on some of these ideas long 10 times, and 6 of those or 7 of those may be incorrect, but then you catch those 1 or 2 like the IWM call from last week where, you just crush it and you come out way ahead, right? That's the that payoff is much better skewed in that respect. And so, kind of backing your point here, I don't know that if you would have bought calls on stuff last week that you necessarily would have made money either, right? Because obviously it depends on what sort of name, but the market also largely stalled out last week after coming off of a very hot week, right? So as a general statement, I would say calls were probably very high priced last Monday, and stocks writ large did nothing, right? We were up, 10%, for example, in the S&P into last week. And then last week we were up a total of 13 basis points from VIX expiration kind of on there. So, long calls in this situation also maybe not have worked out. That's kind of the extra dynamic in options, right? You can be directionally right, but doesn't mean you make money as well.
Yeah, and I will qualify that the call we made on Russell being an own was not based on the idea that we thought the CPI was going to make it rip 5.5%, right? That was not some premonition that we had. That was just, we were saying that was the one that was primed to squeeze the most because it had been beaten up. There'd been a load of call buying. Dealers were clearly short up there, whereas dealers were not short in the S&P and the NASDAQ necessarily, right? So that's what gave it the fuel for the fire, and it needed something to light that match. And CPI gave it the spark that it needed. That was
I totally agree with you. And I think what the key is you're paying the right price. And when I say paying, or in our view, you're paying the right price for something. And paying could also mean, look, you're selling it at the right price. So that's what your scanner does. That's what my scanner does. It's showing you where the opportunity lies and something that we think is attractively priced, either long or short. And we flag that for you. And look, like we said, we think on net these things come out way ahead. And so IWM was an attractive price, and the setup was there, and it happened that markets exploded sharply. You could compare the target exercise where it was interesting to sell the put spread. We didn't have a call spread in that case, so the put spread worked out, but you didn't get the 20% upside, right, in that situation. So it's about identifying attractive prices, and you hope that the trades work in your favor, and that the distribution of price when you're long options in particular. When you catch one of those tails, it can really pay off. So,
but also if you're buying options, like say you've got a positively skewed payoff, but you got to monetize it. If you sit on it for too long, even though you got the move right initially, by being greedy and holding on to it, it just decayed away. So for example, like my first idea here on JP Morgan, that stock has rallied 13% in a straight line since the end of October. It looks massively overbought. It's exactly at the highs that it made on that wick on earnings, I believe that was. So it's clearly a level that got rejected pretty heavily last time round. And so I've said the 1st of December put options are a nice one because the vol's quite cheap and it gives you a couple of weeks for the pullback. But if you get a pullback in the next 3 days before Thanksgiving and you own this put, I'm selling it. You take the money, right? You have to know how to trade these things in real time and know that if you entered it and it's got 2 weeks to expiry, but in the first 3 days it's tripled in value or doubled in value, whatever it might be, I am actually of the belief that the market doesn't dip for very long. I think the broader market has got a dip coming, but I don't think that dip's going to last very long because I think there's a lot of structural buying between now and year end. And there's a lot of people who missed the boat last week and didn't buy enough exposure before that squeeze. That's what it looks like. So, these are considerations that, and I think it's worth having this conversation so people get it. Like signals are signals, but the success of your trading is not based just on the signals. It's based on how you get in and out of stuff. It's based on how you time your execution. It's based on how you monetize, and you learn that through doing and practice, basically, right? So we can't do all of that for you. We can just try and push you in the right direction, what we think makes sense. And sometimes we'll be wrong as well, right? But the idea is that there'll be some value in our process that you'll be able to implement in your process, and net it will help you make money.
100%. And I agree with you on the value of the conversation there. And this is, really quite a move. And so, buying calls into this, doesn't necessarily make a whole lot of sense. And the reason also, to the same point, it's not showing up in our call selling scanner, which it would, which is also has implications for the way that volatility is priced and et cetera. So, it's also notable that the fact that it's showing up for you as an opportunity to buy a put tells us that the implied volatility is positioned so that buying put is more interesting according to your scanner than selling calls and what the value of those options are. Now flipping over to Intel. So your theme here also long puts. These are a little bit longer dated, obviously.
Yeah. So the reason I've gone longer dated on Intel, and that's the thing, like my model doesn't tell me what maturity option to pick. So my model tells me if vol is cheap or expensive, and it tells me if spot is cheap or expensive. But I decide based on that what maturity is optimal. And I look at the shape of the term structure. I look at the momentum of the stock. I look at all sorts of things. And I'm saying that Intel's been on fire recently. Amazing. Right? The market has basically cottoned onto the idea that these guys are releasing all these new server products to try and compete with NVIDIA in the AI space. And they're giving it the benefit of the doubt that he's going to be able to compete in some way, shape or form. So people are upgrading the stock. And whilst they might be able to unlock a load of value longer term, the stock looks clearly quite overbought right now, but the momentum is building on this name. So it might be that the real sort of top in this stock isn't in yet because it's accelerating in momentum. It needs to digest it. It needs to then rally on weaker momentum before it really tops. So that's why I would go out to Jan to give yourself more time. Because if you think there's a year-end rally still, why are you buying a load of puts, basically, right? So, because, with the JP one, we could monetize it in 2-3 days and get out. But with this one, I think it's going to take more time for Intel to pull back, if it does even pull back. So I would rather park that premium in Jan, buy myself a bit of time for that to potentially materialize. Now, if you get lucky and NVIDIA has a shocker on earnings this week, and it just takes the whole semi space down, then obviously you'll do well just owning these puts. But the reason you'll park it in Jan is because you don't need all the stars to align immediately. Right.
And this highlights, I think, what's a super interesting concept is that, I haven't looked at what the implied vols are in NVIDIA. I'm sure they're, crazy. But if you wanted to play a bet on NVIDIA missing, or, coming in under expectations, then an Intel puts or even call, I guess calls would be a little bit different here. But there's some of the other semi names are likely the way that you could express that without paying kind of nosebleed volatility levels, right?
I agree with you in general. It's just you've got to be careful that the stock is actually correlated because in a world like we are now with AI, where these guys are all competing with each other, it might be that bad news for NVIDIA is good news for some of the other semis. You don't know, right? So that's one thing to be aware of. Like how correlated are they, and are they directly competing with each other, and will the market see it that way?
Yeah, because you also have AMD in this situation, which was just doing very well on the same accord there. So great ideas. So the January Intel puts and the December, Imran's a fancy Brit, so he messes up his dates. This is the December 1st, 2023 JP Morgan puts. So those are great ideas. And Imran, we generally try to keep these to about 15 minutes here. So thank you very much for those ideas. You can see now we've been doing these Monday morning calls now. I think this is our 4th or 5th. So please subscribe to us to check those out. Where can people reach you if they want to find more about your macro views and the like?
Sure. So I'm obviously on Twitter, options_insight on there. So, we put daily stuff out on there, but you can DM me if you want on there as well. I have enough bandwidth to occasionally respond there. But really our website is where you'll find all the information about our products, what we do. You can contact us through there as well. There's a contact page. Come check us out.
Awesome. And you can reach us at Spot Gamma on Twitter. We have some great Black Friday deals coming up, so we'll put a link to that in the description and put a link to Imran's site as well. And last but certainly not least, Imran and I have put together an educational course. It's called The Hedge. You can get there at academy.spotgamma.com. We highly recommend that for anyone who wants to learn anything from what's an option on up into portfolio hedging. Or you can click the little QR code that is on the top of your screen there. That will take you to that site as well. And we'd love to have you all as members of that course. All right. Thanks a lot, Imran. Happy Thanksgiving to everyone.
Happy Thanksgiving
here in the States. And we'll be seeing you next Monday.
See you next week. Bye.